Good morning, everyone. Welcome to Aon's webinar on how insurance capital can facilitate M&A transactions in a challenge market. My name is Jennifer Richards, and I'm Managing Director of Aon's Specialties business in Australia. Thank you so much for taking the time to join us today. First, just in terms of some housekeeping before I introduce our panel. Today's session is being recorded and will be available on our website after the session. You have been joined in listen-only mode. That being said, we'd welcome any questions that you have throughout the presentation using the questions window on the control panel. I will be reviewing questions as they come in, and we'll certainly pause to take them as we go along as relevant. Otherwise, we'll make time to address them at the end of the presentation. To the extent we aren't able to get to all of your questions today, we'll be sure to get back to you in writing after the presentation. Great. In terms of the goal of the webinar today, we really want to explore how insurance can be used as a deal facilitation tool to help navigate the choppy waters that we're seeing with the impact of COVID-19. Much has been said and written about the impact of this pandemic. Millions of lost jobs, Japan cast into recession, countries like Singapore struggling through a second wave, and a very uncertain prospect as to the hot time horizon that we're facing. And the impact is certainly being felt in the M&A market. We don't intend to cover all of these statistics in any further detail today. Instead, we really want to focus on how insurance can help deal makers and practitioners get deals over the line in circumstances where they might not otherwise. A brief outline of our agenda today. We're first of all going to focus on what solutions are available to support your M&A deals. We're then going to go through some case studies, which will bring these solutions to life and show you some different structures. We'll then have a discussion about the current market, what we're seeing in terms of trends, how insurers are dealing with COVID-19, and some observations as to how to navigate through those observations. We'll make some recommendations to you as to how best to run a transactional liability insurance process in the current market. And then finally, as I said, we'll close with some questions. Before we jump into the materials, I'd like to just briefly introduce our panel today. We're joined by Sam Thomas. Sam leads Aon's transaction liability business in Australia and has over 13 years of experience in tax and law. Sam has specialized in structuring insurance solutions on M&A deals for the past 5 years. Jonty Vavasour leads our M&A practice in New Zealand. Before joining Aon, Jonty held senior roles at Bupa in both Hong Kong and London, and he's practiced at leading law firms in London, Melbourne, and Wellington. Sandra Lee runs our transaction liability for us in Asia and has some more than 17 years of legal and insurance experience. Sandra and I have worked closely together over the last eight or so years. Geez, I feel like I'm aging myself. When Sandra joined us from a legal career in Singapore, Paris, and Hong Kong. Martin is our tax insurance leader in Asia and has over 11 years of legal and tax experience. Martin has practiced in leading firms in London, the Netherlands, and Hong Kong before heading the tax and restructuring team for a listed European multinational. Welcome to our panel, and let's jump into the materials. If you could move to the next slide, please, Jody. I'd like to hand it over to Sam, who's going to explore how insurance solutions can unlock value in the current market, in particular in respect of distressed transactions. Sam, over to you.
Thank you, Jen, and welcome everyone. We're so pleased to have you join today as we unpack how transaction liability products can assist in distressed transactions. As the impacts of the pandemic are just beginning to be understood on the wider economy, we expect it will negatively impact a wide range of companies and force them into a distressed situation. Typically, transactions in a distressed environment also come with their own structural challenges, and where sellers and management are unwilling to stand behind historical breaches of warranties and indemnities. These sorts of transactions typically lend themselves to be on an as-is, where-is basis with limited protections for a buyer and without a solvent counterparty in the instance of a breach. However, there is an opportunity for transaction liability products to actually facilitate distressed transaction, providing both sellers and buyers with effective solutions. Firstly, to facilitate transactions. The risk in a distress context for sellers is that buyers undervalue the target due to its present condition, especially where they cannot appropriately quantify certain risks, or where there may be potential liabilities that can't be settled in the transaction timeframe. Insurance can actually be an effective tool for the risk transfer of contingent liabilities in these times, so that an insurer is willing to take on those potential liabilities so that deal makers can rather focus on value creation. For buyers, the risk is that it can be difficult to accurately quantify those potential liabilities, and there is no appropriate counterparty to claim against, where administrators are generally reticent to provide meaningful warranties in their own capacity. Insurance markets certainly have appetite to cover targets in distress, and there are ways that they can assist with facilitating transactions so the insurer can stand behind the warranties in the instances of a breach and can specifically or a specifically identified tax issue or contingent liability issue. Next, the insurance markets can also create liquidity, and the key to creating liquidity for creditors and stakeholders is to eliminate uncertainties which might arise from tax risks or contingent third-party risks, so that if these risks exist, they're able to be presented in a way that's easily digestible for buyers so that they can have comfort not to derail the process. Once the risk transfer is achieved through the insurance markets, this eliminates the need for holdbacks or escrows, which can erode value and hence achieve a positive P&L result. Insurance markets can also preserve value for creditors. The primary objective for a seller or administrator to ensure they meet their fiduciary obligations to create value for stakeholders and creditors is to facilitate a sale at the highest price through a process they control and mandate. Since in distressed transactions, administrators don't stand behind the warranties, it would be sensible that an insurer with a healthy balance sheet is available to do so. This attracts a wider pool of potential investors and encourages a more robust auction process, providing certainty of counterparty, where an insurer who is used to dealing with claims as the counterparty and again eliminates the need for holdbacks. There are also other structures that we'll explore today, such as synthetic warranties provided by an insurer and used primarily in the context where sellers or management or the target is unable to give the warranties for whatever reason. In other instances, there are questionable tax positions or potential liabilities, and we'll look at how we can use insurance markets to ring fence that issue and take them off the negotiating table. Products also exist which enable you to unlock value in the balance sheet, so that assets on a balance sheet, such as a target's IP, which can be difficult for a buyer to see value in, can be unlocked. Finally, these products are also designed to accelerate value to stakeholders. They take the heat out of negotiations to reduce the time spent on negotiating warranties and enable quick, efficient risk transfer for identified issues so that parties can move quickly to completion. It enables creditors and stakeholders to receive their proceeds quickly. Having the ability to recut the deal in a new way also empowers management to look to build value again in the target, having seen off the distress, and provide certainty to stakeholders such as employees and creditors and other third parties. Could we please move to the next slide? So I want to take a few minutes to talk about 3 key risk transfer tools. Firstly, W&I insurance, which you may be aware of. This is a product where the insurer is willing to stand behind market standard warranties and indemnities to provide under a sale agreement. Warranty and indemnity insurance is a customary deal protection mechanism where it provides the buyer with financial recourse in the instance the buyer discovers a breach of warranties or indemnity, and the buyer is able to be indemnified for those risks by the insurer. It's been a tool that's been used in our jurisdiction for some time, and it's no different in a distress situation. The key benefits include the ability to structure a nil recourse or clean exit for sellers, cover market standard warranties such as title, tax, general business warranties, and a pre-completion tax indemnity in accordance with the sale agreement. It's very much a bespoke product. It's drafted on each deal in line with the sale agreement, and our teams are stacked with former M&A lawyers who can craft a policy to closely mirror the sale agreement And oftentimes, the insurance markets can provide more enhanced metrics, such as flexible retention structures, greater maximum liability limits, and policy periods than what you might be able to receive from a seller absent insurance. It can also be used to facilitate a robust auction process. In distress sales, the obvious question is who will stand behind the warranties post-closing when you have a distressed counterparty. But the buyer here still gets market standard warranties, and W&I Insurance can actually encourage bidders such as PE bidders to participate in such a process and enable them to appease their investment committees to satisfy liquidity in terms of recourse in the events of a breach. Moving on to pricing, typically pricing for W&I Insurance has been in the order of about 1 to 1.5% in the Australian jurisdiction, Australian New Zealand jurisdiction, and it's a little higher in Asia where that range can reach up to 2%. We'll go through some pricing impacts of COVID-19 from the markets a little later. It solves structural impediments where typically the sellers stand behind title warranties up to the purchase price. So where that's not possible in a distressed context, we can structure title capacity pretty quickly up to the purchase price very cheaply. Pricing for title risks also can start as low as 0.6%, and it could even be lower with specialty title insurance. Now, what W&I Insurance is able to cover is historical unknown risks that an insurer gets comfortable with through reviewing comprehensive diligence processes. So now moving on to some of the other tools. In the deal context, there can also be a continuum of both known and unknown risks. While W&I Insurance would cover known risks, products like tax insurance and contingent insurance can assist, particularly in distress transactions. You tend to find that there are complex issues dealing with tax restructuring or potentially third-party proceedings. These products allow.
Sam, why don't you put your phone on mute briefly and let's see if we can deal with that sound issue. Why don't I perhaps pick it up from Sam? Sam, would you like to test your sound one more time to see if it's working better?
Sure. Is that coming through better?
Yeah, thank you.
Excellent. Okay, so I might just pick up. So tax insurance can cover off losses arising from certain tax positions taken. These can cover off specific risks that exist, and survival of carry forward tax losses is an example, tax treatment of group reorganizations, treatment of indirect taxes, withholding tax issues, and transfer pricing, to just name a few. Contingent risk insurance can also cover potential liabilities such as outstanding litigation, contract disputes, issues with fund wind downs, valuation questions on transactions, antitrust issues, and change of control and novation of contracts. Understanding that these risks are very much for known issues as opposed to W&I insurance, pricing for tax insurance can range between 2 to 8% of the limit of liability, and for contingent risks, it can range from 4 to 15% of the limit of liability, depending on the complexity of the issue and likelihood of an adverse outcome.
Excellent. Thanks, Sam. Why don't we move on to the next slide in terms of a brief discussion around an area where Aon is really leading the charge in terms of innovation, and this is in the area of intellectual property. I'd like to turn it over to Sandra, as I think this is particularly relevant in the current market as to how insurance can help deal makers protect and increase the value of their IP portfolios. Sandra, over to you.
Thank you, Jen. With 19 trillion, or nearly 85% of the value of the S&P 500 represented by intangible assets, investment in intellectual property has changed the global landscape across industries and regions. Many companies, however, have been slow to adapt new approaches to managing and valuing their IP portfolio in a manner that fully captures the value. Aon has put together a suite of IP solutions to help clients protect their most valuable asset in today's business world, their IP, and actually create enterprise value by going beyond looking at the legal framework to align current and future IP assets through valuation and risk transfer tools. So this slide just seeks to provide an overview of how Aon is able to assist when evaluating a transaction which may be heavy in IP assets, from conducting IP valuation through providing a qualitative and quantitative analysis of the IP portfolio, that's on the top left-hand corner of this page, as well as benchmarking them against other registered IP in order to value their strength and true value to the target business. In addition, at the bottom left-hand corner of this slide, where there are concerns or challenges to the IP rights, particularly in a pre-IPO situation, ring-fencing these IP with an IP liability insurance policy can protect them from future challenge by opportunistic or potential challenges. In the same theme, where there is a concern around loss of trade secret through rogue employees, third-party unauthorized access disclosures, trade secret theft insurance can be utilized as well. The intention of today's session is really just to provide an overview of the various IP solutions that may be utilized in transactions, whether distressed or otherwise. And as we will not have time to go into the detail of how these IP solutions will work, we will move on to the next slide. Of course, if there's particular interest in this topic, please do send us your feedback and we can address them accordingly. Back to you, Jen.
Thanks, Sandra. We thought now we'd move on to a series of case studies just to bring to life some of the commentary that Sam and Sandra have addressed so far, just around how deals can be facilitated with insurance. And we'd like to start with the first case study around the sale of a business in administration. Sam, would you like to take us through this one?
So this is an example of a sale of a business in administration. We were acting for a high-profile company in distress in Australia. It was a sale of a division of a $1.5 billion mining consumables company, which was actually quite profitable and seen as the jewel in the crown in an otherwise distressed group. We were contacted by the administrators of the transaction to see if we could help with the sale process, and they were charged with running a robust auction process. And we formulated a plan to exact value out of that process for all bidders. The administrator took our advice and ran a really tightly controlled administrator mandated process. We worked with the administrator to reach out to the insurance markets well in advance of a warranty package to get their commentary on that package and make sure that it was insurable. We were also able to structure over 300 million of cover for the transaction for the buyer as needed. The administrator in this process was able to provide vendor DD reports for the benefit of all bidders, and we were able to get the insurer comfortable that the content of those reports and the data room well in advance of the final bidders being chosen. The administrator really took our advice on controlling the insurance process till they were able to identify who the final bidders were and only hand them over to the insurer once they were able to show intention to complete. Here we were able to facilitate a hotly contested auction process for the ultimate buyer, which was a USP buyer, where the target itself provided the warranties under the sale agreements. It was an effective solution because pricing and coverage was efficient for all buyers as a program was structured in advance, and the insurer were able to run multiple trees for the transaction to facilitate bidders going through the overall deal process. Given it's a small market, controlling the process stopped conflicts where individual bidders reached out to the markets separately, conflicting out underwriters or insurers. We were able to ensure a clean exit for the administrator by structuring a no recourse deal. The buyer was able to receive full suite of customary warranties akin to what they were used to receiving and was able to satisfy their investment committee and push out cover under the policy for better metrics such as tipping retentions, longer policy periods under the policy that an administrator couldn't provide. Also, just to hark on a point, in terms of market capacity, there's in excess of US 1.5 billion of insurance capital available on any one transaction. So our recommendation is that this is initiated early on the sell side to ensure an efficient process. Over to you, Jen.
Thanks for that, Sam. Sandra, as Sam touched briefly before on the concept of synthetic warranties, I was hoping that you could take us through an example just to bring this concept to life.
Yes, thank you, Jen. So for a number of years now, insurers have moved from requiring minimal seller recourse to nil recourse altogether on any transaction that is insured. This is now the typical structure in the Asia-Pac region when W&I insurance is used, not as a supplement, but rather as a replacement of seller indemnity altogether. In such transactions, notwithstanding nil recourse, insurers will require a set of reps and warranties to be written into the transaction docs and involvement from the sellers or management in putting together the disclosure schedule. In a distress situation, however, where the actual sellers or key management are not available to put together the disclosure letter, and/or if the administrators are not in a position to offer any operational reps relating to the business, buyers have no choice but to accept that the target business as is and price in the risk of nil recourse against nil reps and warranties. In this example, we will share with you a case study where we have helped a client with removing this hurdle, which would otherwise have been a deal breaker for them. The buyer was buying a real estate portfolio, which was, as a result of financial difficulties, legally held by a disparate group of shareholders, bondholders, and other entities that were in liquidation proceedings. Each seller group entered into broadly similar SPAs with the buyer, under which only title warranties were given. It had not been possible to negotiate meaningful business warranties against the administrators, and none were therefore written into the SPA. Under a typical structure, W&I insurers would have required seller or management involvement in negotiating the reps, or at least demonstrating some form of negotiation through exchanges or markups of the SPA as well as a disclosure schedule. Here, Aon arranged a policy that deemed the SPA to have included the standard warranties that would have been given as if it was a standard transaction, but that were in fact actually just annexed to the W&I policy, thereby providing the buyer with protection against a set of meaningful reps that the buyer required through the W&I policy without any recourse or involvement whatsoever from the administrators, sellers, or management. This was really only possible because the insurer had been able to review extensive due diligence reports that the buyer had put together through the help of their advisors and had compiled very detailed work and Q&A responses involving the sellers and management, facilitated by the administrators. Jan, back to you.
Great. Thanks, Sandra. We'd like to move now to an example as to how a combination of insurance solutions can be used to address multiple parties' concerns in a sale transaction. Martin, could you take us through this example, please?
Thanks, Jen, and good morning to everyone. Yeah, there are many examples of how tax insurance and W&I insurance or other risk insurance tools can be used simultaneously. And this case is one of the examples. So in this case, we were representing a UK group that was in the process of disposing of its assets before, by way of a third-party sale, before winding down in a voluntary liquidation and distributing the proceeds to its shareholders. So prior to the sale of all the assets, there was a restructuring which gave rise to several low probability tax risks, which the liquidators wished to mitigate. These risks related to the validity of group relief claims, whether a tax charge would arise on the waiver of outstanding loan receivables, and whether a number of inter-group and third-party share transfers would result in a taxable gain. Well, this gave rise to issues on a few sides. First of all, the buyer was not able to get any meaningful tax indemnity and other recourse from the seller because the seller was going into a voluntary liquidation. So, the recourse wouldn't mean anything. Secondly, the liquidator of the seller was concerned about the tax risk that had arisen in the restructuring, and the liquidator wanted to have protection before distributing the proceeds. So what we did in this situation, we arranged two different policies to cover this deal. First of all, a specific tax risk policy, which protected the liquidators against any tax risks, so they could freely distribute the proceeds. And second, a buy-side W&I and tax policy for the seller, so that the seller could have, also a meaningful recourse in case of any issues related to the business they were acquiring. So yeah, these policies allowed the sale and liquidation distribution to proceed, with no buyer discount being applied for the lack of meaningful recourse. So this was a very good example of how insurance can facilitate a distressed deal. Back to you, Jen.
Thanks, Martin. Wanted to ask you now, take us through this other example of tax insurance, in particular how it was used to unlock cash held in escrow, which was a use that Sam described earlier. It'd be good to see a practical example of that.
Yeah, thanks, Jen. This is indeed a situation that we often see in practice, and we get a lot of queries about this. So the case here was as follows. A seller was a PE fund and was selling a shareholding in a foreign entity. Well, based on the local laws of the jurisdiction where the entity was a tax resident, the capital gain that seller realized because of the sale was taxed with capital gains tax. And the way this tax was levied was by withholding on the purchase price paid by the buyer to the seller. The seller, however, claimed that the investors in the fund, which were the ultimate beneficiaries in the structure, were eligible for exemptions of capital gains or reductions of capital gains tax under tax treaties. So they said they had a good position to defend that. However, there was a small risk that these exemptions would not be granted by the local tax authorities, and the buyer was not willing to take this risk because the buyer was responsible for the withholding of this tax. The buyer therefore required an indemnity and an escrow from the seller in the amount of $25 million, tied up for a period of 10 years. Well, this would of course impact the IRR of the PE fund, and also it would prevent the closure of the PE fund. Well, in the negotiations, the seller therefore negotiated an option to replace the escrow with a tax insurance policy paid by the seller. So 2 years after closing, we started the process after the closing, we arranged a tax insurance policy in the name of the buyer for the risk that the local tax authorities would challenge the amount of capital gains tax withheld. Well, the effects of this, first of all, the buyer was protected against the capital gains tax risk. Second, the escrow could be released, which improved the IRR for the seller and also enabled the seller to close the PE fund. So yeah, this is an example of how you can see how tax insurance can be used to unlock cash that is locked. Back to you, Jennifer.
Yeah, thanks for that, Martin. Sandra, we've had a bunch of questions come in on the topic of synthetic warranties, which I imagine would be the case. It's kind of a hot topic right now. Wanted to ask you, one of the questions, kind of the theme of the question coming through is around if the synthetic warranties are available, why don't we see them in a more prevalent way in the market? What are the limitations to insuring synthetic warranties, and how accepted are they in the market?
Sure. Thanks, Jen. So synthetic warranties are not available on all deals. Insurers, as a first part of cost, will prefer the conventional structure where the reps are given by the seller and appropriately disclosed against, whether prepared by the sellers or the management, where the disclosure schedule is concerned. As a next alternative, if the sellers aren't available, if they're about to be wound down or they've just been sort of a disparate group of sellers, insurers will prefer management to stand behind the reps, either in the form of a management warranty deed or to at least be shown to be involved in putting the disclosure letter together. Where a selling entity or management cannot give warranties at all, so as a last recourse, for example, you've got a creditor that's selling post-enforcement, you've got sellers or management no longer available or involved, and or liquidators who have no appetite for any liability against them. This is when insurers may be willing to explore the use of synthetic warranties, which is the case study we just shared, as an absolute last avenue. From my experience, they really will only do so when the diligence available for the transaction is fulsome, the data room is comprehensive. It would be ideal, although not absolutely necessary, but ideal if there was vendor DD available as well, on top of which buyer DD then tops up the gaps. And also if either of these apply, where it's either a SME type business or that the target business does not operate in multi-jurisdictions. A very complex multi-jurisdictional business will be hard for insurers to offer synthetic warranties, just because when they get advice from their external counsels, they'll be kind of at a loss as to what would be the standard market set of reps that would apply for that multi-jurisdiction business. Jen, I hope that answers all the questions.
Yeah, I think that's very, very consistent with my experience as well, Sandra. And kind of on a related topic, I suppose, a piece of advice that we often give clients around this, you know, to the extent that you're somewhere between having an active seller involved and the far extreme of synthetic warranties. Frequently, what we see as a structure is that we have the target company give the warranties where the seller won't or can't, for instance, in a public to private transaction, as you said, with, you know, if there's a large number of public shareholders, or in the instance where the seller can't provide the warranties for some reason. Frequently, the structure that we've been using in the Australian context has been to have the target company give the warranties. And you know, one of the issues that we frequently get questions on there is around what happens in the event of a subrogation claim, and something that we just have to kind of, in the same way as the synthetic transaction, kind of work through some of the complications around that, and in particular, the way that standard insurance policies work, buy-side insurance policies, is that in the event of a fraud, the buyer is still able to recover under the insurance policy, but once that claims payment is made, the insurers have the right to subrogate to that to the buyer's position and pursue a claim against the seller only in the instance of fraud. So in the context where the target's giving the warranties, we do have to work through that implication, because by implication on those deals, the insurer would have a subrogation right against the target company in respect of fraud, and that does raise issues of circularity for buyers in terms of the, you know, not getting, they get cover for fraud, but it becomes a circular issue insofar as the target company would have to pay back out on that fraud. That being said, you know, we haven't seen a lot of fraud claims in the market, if any. You know, it's very, very rare. And we haven't really seen that to be a structural impediment, but it's certainly something that we do remind clients of in that context. Excellent. Why don't we move then to the next subject area that we wanted to cover today, and that's really around what's happening in the market in relation to COVID-19. How are insurers responding? What are the prevailing market conditions? And is there anything that our clients need to be aware of in terms of how to deal with these implications? So over to you, Jonty, to take us through what we're seeing in the market.
Great, thanks, Jen, and good morning, good afternoon, everyone. I'm just going to spend a few minutes now looking at the impact that COVID-19 has had on W&I metrics across APAC. But before I do, just a couple of headline points. Look, with fewer deals on right now, there is capacity in the insurance market, and insurers are certainly keen to transact. That said, the insurer's guard is up in terms of ensuring a robust underwrite in this volatile environment. Anecdotally, what we're hearing from insurers is that when the targets don't perform as expected, there is an uptick in claims. But now looking at the actual trends on the slide, you can see there for Australia and New Zealand, we think premiums will stay steady at or below 1%, mainly due to the continuing competitive insurance market and also the available insurance capital. In particular, we're likely to continue to see very good value in the excess markets. This means larger limits will see even more competitive pricing. For the rest of APAC, rates are slightly higher. That really reflects the diverse and higher risk jurisdictions, such as those in Southeast Asia and also China. Turning now to the average of limit of liability, this is really similar across APAC, and we see two competing factors. We may see limits dip on deals where cash flow concerns are dominant. However, on the flip side, coverage will be good value, so some buyers may be enticed to take up extra coverage in riskier transactions. Just moving to the next slide. If we look at deal structure, we expect to see seller-driven processes continue their popularity in order to drive a robust auction. And also, as Sam has mentioned before, we will also see administrator-led auction processes as well. Turning now to the retention or the deductible, this is mostly consistent across APAC, and I think that the name of the game here is just providing flexibility for the buyers, and we will continue to see enhancements offered for retentions below 1% of EV. Now, buyers understand the price trade-offs for lower retentions, particularly if they perceive higher claims risk on a distressed deal. On the flip side again, given the focus on cash, buyers may be slightly more reticent to pay for that extra enhancement. I'll cover off some other deal dynamics such as due diligence and new non-breach cover a bit later, but if we move to the next slide, before I actually get into those increased underwriting focus areas, I'd just like to speak about how insurers are addressing COVID-19 in the W&I policy. So look, when COVID-19 became a major global pandemic back in February, most insurers, in somewhat of a knee-jerk reaction, moved towards mandating some form of a COVID-19 exclusion into the W&I policies. However, we have seen a swift evolution away from this, as insurers can now look to underwrite to the risks. Where an exclusion isn't retained, we will work with the insured to make sure it is as narrow as possible, thus preserving the value of the policy. And look, I think looking forward to the next few months, we believe there is genuine scope for differentiation amongst insurers at the marketing phase in respect of any proposed exclusion, and we can apply some competitive pressure up front to understand what the insurer's intention is in respect of any exclusion. So just staying on the same slide, looking at the areas of increased underwriting focus areas, financial performance. Insurers will pay close attention to the recent financial performance and day-to-day trading of a business, particularly those at the smaller end of the EV spectrum, and also perhaps those in vulnerable sectors like tourism and retail. We've got the Q1 results through, but I think it's really looking at those April and May results, which will show the full impact of the lockdown, at least here in Australia and New Zealand, and how these may impact solvency warranties in particular. Valuation and multiples. Insurers will always look closely at the valuation of businesses in this environment to ensure the pricing multiple makes sense, considering the updated revenue outlook. And the multiple here is important because often it is used to quantify the total loss of a buyer. So if we could just move to the next slide, please. Thanks, Jody. So looking now at the specific warranties of concern and looking more at the granular impact of COVID-19, we've touched just before on the solvency issues, but looking at supply chains, the insurers will be interested in how robust the target supply chain is. Does it have, for instance, the ability to diversify, and to what extent is it impacted by international uncertainty? Looking at material contracts, especially those with a cross-border element, has the buyer assessed the material contracts to determine termination rights that may be exercised because of the COVID-19 situation? Is there a risk of non-performance by a counterparty, and is there an alternative counterparty available? Employment issues, look, these are a big issue both in Australia and New Zealand, but putting to one side the Holiday Pay Act issues and the awards issues in Australia, insurers will be keen to understand whether any wage subsidy has been received by the target. There are two issues here. The first one, was a target actually eligible to receive the wage subsidy, and did they receive the correct amount? And furthermore, we know there has been widespread enforced pay reductions across all industries. Insurers will want to make sure that these were made in compliance with employment law. And lastly, I'll just call out data protection and privacy, which may not be considered to be directly related to COVID, but we've heard from a number of our cyber colleagues there has been a sizable increase in the amount of ransomware attacks over the past few months. Hackers are clearly looking to exploit companies when their guard is down, and insurers will be focusing on this area accordingly. So overall, the takeaway here is that there will be another lens that the insurers will be considering a business under. There should be clear contemplation of the potential impacts of COVID-19 in any scope prepared by advisors, and each section of a report, whether it be tax, financial or legal, should really prepare a view on the various impacts of COVID. And again, the advice is to be as clear as possible and emphasising the work carried out directly in respect of COVID risks. So turning to the next slide now. Looking at the interim period considerations here between signing and closing. Given the current volatility, there is a risk for insurers during this period as they are generally prevented from topping up their diligence at completion. This risk has been exacerbated of late due to the delays with FIRB and OAO and other approvals throughout APAC. So what trends are we seeing? We are seeing an increase in the use of MAC clauses. Now, usually the drafting of these is within the purview of the lawyers, but suffice to say that where a MAC clause is triggered and the share sale agreement is terminated, the W&I policy will follow that form and will also fall away. Looking at disclosure, as mentioned before, given the lack of top-up due diligence at completion, insurers will consider how robust the mechanism is in the SPA for updating the operational position during that interim period, particularly on trading updates and so forth. What this does is it gives the insurer comfort that the insured has all of the relevant information available to it when it gives its closing no claims declaration. Looking at new non-breach cover, insurers will look carefully now at offering this enhancement. This is cover for breaches of warranties which first occur after signing, but before completion and is discovered by the buyer. We have seen a reluctance recently by insurers to offer this enhancement due to the current volatility. However, again, we see this as an evolving issue and will certainly be something that we can apply some competitive pressure on when we are marketing the transaction. And lastly, just thinking about additional insurances, policyholders can always supplement their W&I insurance policy by taking out some more operational style insurances like cyber, property, D&O, and general liability. Jen, over to you. Thank you.
Great. Thanks for that, Jonty. Certainly a lot of moving parts right now in the market. And I think if we describe our experience across APAC over the last few months, it's been sort of a week-to-week review as to what the latest issue is that insurers are trying to get comfortable with. And I think you're exactly right flagging the wage subsidy piece, because I think that's certainly an area which is going to be unfolding more as we understand the treatment of those wage subsidies. And certainly prior to the crisis, insurers were very, very deep into their employment matters due diligence. So I think that that'll certainly be an area of interest going forward. Wanted to ask a general question to the panelists just around process and some observations that the panelists might have around how best to structure a process right now in the current environment. You know, how much lead up time do we need? Is there anything in particular that that clients should be conscious of in terms of the need for vendor due diligence or certain types of buyer due diligence? Sandra, maybe I'll turn it over to you first, just to give your observations from what you're seeing in Asia.
Sure. Thanks, Jen. Yeah, I think from our perspective, you know, to echo what Jonty has said, some of the transactions involving supply chain logistics that obviously impacts China, North Asia, which was the first impacted countries for COVID, they've quite early on been taken off the shelf. So from a process perspective, the new transactions or the later transactions that we've been working on, insurers have been quite keen on focusing on these areas during the due diligence. Would say to clients, when structuring your due diligence, you have to demonstrate that you've had access to the information despite the lockdown, despite the lack of travel. They will want to see that appropriate DD around the key areas have been done. In particular, for those processes that started due diligence before the start of the COVID lockdown, so sort of end of last year, early this year, how has that impacted valuation and their view of the impact of COVID on the business performance? That will have to be sort of flowing through the financial, the tax DD and the operational DD. In order for them to take comfort that the insurers aren't being used as a backstop measure for the losses that might arise as a result of COVID lockdown.
Yeah, Sandra, on a related question, we've had a question from an attendee, which I think is a good one, and it's related to that. You know, Sam shared an example where there was a sale out of a distressed organization, but the entity being sold was still solvent. What are your observations about being able to get accounts and financial warranties covered in respect of a distressed entity itself? Do you have any observations on that?
If it's a solvent entity, I don't see why we wouldn't be able to get the usual coverage that we would normally.
So a company that's in distress, as a not solvent.
So the company, yeah. So the target company itself that's insolvent, yeah, not the sellers.
Correct.
Yeah, I think that would be tough in the sense of the types of warranties that we'll be looking for coverage on. Insurers will want to scrutinize the level of DD that's been done and what they're standing behind. So collectability of debts, for example, typically not covered anyway, would be even so more under scrutiny here. The immediate reaction we've got from insurers talking through some of these issues is they will be reluctant to sort of go that route and be the backstop on sort of bad debts, if you like, and all the warranties surrounding it will have heightened scrutiny. Yeah. But on the backhand, you know, on the other side, when it comes to all other matters, contract, suppliers, key compliance issues, etc., will be covered as you would normally expect.
Yeah, and I think that probably relates to John T's observation earlier as well around a concern that insurers have that where a business doesn't perform post-completion in the hands of a buyer, we see a larger frequency of claims. And so I think that will also drive a lot of those concerns, is just understanding where the insurers think the claims could potentially come from post-completion. Martin, from a tax perspective, what are your observations as to the implications of COVID-19 in respect of what you're seeing in respect of tax inquiries?
Thanks, Jen. I think for tax insurance in APAC, it's still very early days. You know, for example, in the US and in Europe, this is more like an established product, but in Asia, it's really early days. What we're seeing is that because of the COVID developments, we see an increase in inquiries, and that probably has a few drivers. One of them is that at the moment we see that a lot of governments all around the world, and particularly in APAC, are supporting us, providing a lot of support measures, which has a big impact on their budgets. So there will be, you know, when that impact becomes clearer, they will be on the lookout for additional tax revenues. It's unlikely that they're going to collect these tax revenues from their own local companies and citizens, because they are already suffering. So they will probably look at multinational companies, which is in line with the development that has been going on for some time already, where, you know, multinationals are assumed not to pay their fair share of taxes. So we expect that there will be much more scrutiny on tax practices of multinationals, more risk, and that is probably one of the reasons why we're seeing an increase in demand inquiries for tax insurance. And that only further drives the development that was already going on with a lot of the London-based tax insurers going into Asia, where they can get a higher yield on their capital. We actually think that COVID developments are going to be quite positive for tax insurance in APAC.
Interesting. Yeah, I think that multinational angles a really astute observation there. We've got a few questions that have come in since we started this discussion, so I think maybe I'll turn to a couple of them. And as I thought, there's further questions on synthetic warranties, Sandra, which maybe I'll package up for you. The one question is the pricing the same for them as it is on standard warranty cover? And are the warranties only contained in the policy document, or are they contained elsewhere? And then on a related question, there's a question here around how much due diligence is required. Is there the requirement of Q&A with the seller or the target? What's required in terms of disclosure letter?
Okay, well, that's a lot of questions. So let me take them all one by one. I was having difficulty hearing you, Jen. Is my connection all right? Just wanted to test.
Yep, you're good. So the first
Okay,
question was
good.
pricing.
Pricing. You would expect a bit of a higher pricing. I would say anything between what you see in APAC versus what you see in the US. So something in between. So not as high as what you see in the US, but certainly not as cheap as what you would normally see on a plain vanilla deal. Expect probably around a 30–40% increase in premium. That's our observation so far. And really that comes down to obviously the heightened risks that the underwriters or the insurers are taking on, as well as expect also a higher underwriting fee to be charged. I know in some parts of Australia or with some insurers, perhaps underwriting fees are actually subsumed within the premium, or insurers actually do not hire external counsels. In the Asia region, insurers certainly on all deals would hire external counsels. So those external counsels fees, expect them to be a lot higher. From my experience, that was at least threefold, because again, if you wind back, the work that is expected to be done on the sell side is now transferred completely to the insurers and their counsels. So that obviously would bump up costs. So that's on the cost perspective. The second question was around what was it, Jen? Around sort of
where they're contained, where the warranties contained.
So by that very definition of synthetic, it will be in the policy. There will not be any works and warranties annexed to the SPA at all. You will not see that in the SPA. There'll be appropriate provisions written into the policy to deem the warranties as if they've been given in the SPA, but which does not appear there, and it's completely just part of the policy. So that's how you would expect it to be packaged. And as a result, I think one of the next questions was around DD and disclosure. So correspondingly, flowing from that, you wouldn't expect a disclosure letter to be part of the SPA. The entire process, if you like, of checking the warranties, checking against the disclosure process, checking against the data room is completely done by the sellers, done by the insurers and their counsels. So assume or think about the entire process of negotiating the reps, of checking through the data room, checking through the DD, or the counterparties, if you like, from a buyer perspective, being the insurers here. So there's a lot more involvement of the insurers when putting together a synthetic set of reps and warranties to the policy.
And if the warranties aren't being given by a seller or a target, and essentially they're just artificial, what is the position in respect of fraud and subrogation rights? Does the insurer have any subrogation rights?
No. No. So typically, on the last deal that we did, the buyer had to take comfort that there was no coverage for fraud of the seller, basically, because the insurers weren't able to subrogate against them.
Yeah, so presumably the only subrogation rights under the policy would be the standard ones, where if there's a third-party claim or something similar, they could step in the shoes. Yeah, right. But in respect to the seller, there is no seller warrantor to go after. That addresses the questions we've had to date on synthetic, but I'm sure that more of them will come in. We've got a question here on tax, which I will put to Martin. Can W&I cover tax issues, or do you need a separate tax product to get coverage for tax warranties and a tax indemnity?
Thanks, Jen. Yeah, to give a short answer to the question, it really depends on the nature of the risks. Sometimes what we see in W&I policies is that you have a few small tax issues that can be added to the policy. In general, I would say if the tax risk is material, and if it's if it requires a lot of analysis from the insurer, you would be looking at a standalone tax policy because the insurer will want to get comfortable with it. So it's generally the more easy tax risk would be possible to add to a W&I policy, and we have done that in the past.
Yeah, and that would certainly be true in Australia and New Zealand. I think one of the sensitivities around that, Martin, always is around frequently with tax issues, you actually want bespoke cover that actually speaks to the way that the defense of the matter is going to be handled, how defense costs are handled, and warranty policies don't have those procedures built in. I think also in terms of adequacy, the limit of liability, frequently for tax issues, parties want to make sure that the limit of liability is preserved for the tax issue because there's actually a quantum on the particular tax issue, as well as retention considerations and the like. So I think that you're exactly right. That's a trend that we've seen here as well in terms of simple, smaller issues. You can frequently tuck them into a W&I policy, but to the extent they get more complex or sizable, certainly a bespoke cover would be more appropriate.
Yeah, absolutely.
Jen.
And insurers are also open to discussing it. They're getting more familiar with tax risks, both in the W&I context as well as the tax insurance context. So yeah, it's good to see an increasing appetite for tax risks, certainly.
Yeah. Sandra?
Jen, if I can just add on, because hearing your question earlier, I wonder if the question was relating to general tax warranties that you would normally see in the reps and warranty schedule, or a tax indemnity. If that was the question, then the simple answer is it would be covered as part of the W&I policy. If the question was around identified tax issues, then our earlier answer and discussion will hold through. So I guess just differentiating the two parts would be useful for answering that question.
Great. Thanks for that clarification, Sandra. Excellent. We've got another question here about new breach cover, in particular around the coverage that has been quite popular over recent years in respect of procuring coverage for new matters that arise after signing but before completion, that are identified by buyers prior to completion. Jonty, the question we've got here is, what is the impact on the expansive regulatory approval periods now and the delays that we're seeing there? What are the cutoff periods that we're seeing for that new breach cover? And is there appetite to cover new breaches on deals that have FIRB and OIO approvals?
Yeah, sure. Thanks, Jen. So I'll just unpack that question. So the first one was sort of around periods for new breach cover. So traditionally, insurers will offer new breach cover on a sort of rolling 30-day period. So once you sign, you'll be offered, say, 30 days worth of new breach cover. We've actually seen that reduce as well. So some insurers are sort of reducing that to maybe 10 business days. And then once you get to the end of the period, you then essentially need to reapply for that coverage to continue. So again, it's sort of rolling. And insurers will always have the discretion to actually, cease providing that cover if they get uncomfortable. But usually we would expect the insurers to continue providing that cover up until completion is attained. Now the cost is usually around about 10% of your total premium for a 30-day period. So it's an extra 10% on your total premium. Whether these longer approval periods are having an impact, because the period is sort of limited anyway, so the insurer, they don't need to make a binary choice at day one when they don't know whether it's going to be 2 months or 6 months. So I think they can sort of get comfortable on those longer periods, but I think it's more around the fact of COVID and the sort of very much an uncertain outlook, which is more tempering their appetite for offering new breach cover at this stage.
Okay. Thanks for that, Jonty. And certainly, I think it's one of those areas that is continually changing, and we'll certainly continue to press insurers, provide us with some more certainty in that area as well. So I'm conscious that the hour is fast upon us, and that's probably all we have time for today. There's a couple of questions we didn't get to, but we'll come back to you in writing on those. I'd like to thank everyone very much for your time today. It's really been our pleasure. We're here to support you and to help you get your deals across, and the team really looks forward to working with you all in the coming weeks and months. And in the interim, we really hope that everyone keeps safe and well, and look forward to catching up soon. Thank you.